You're listening to The Intellectual Investor, episode number 5. Stock investors, you have nothing to fear but fear itself. Written by Vitaliy and read by Elliot. To read this article online, or to listen to more episodes, visit investor.fm. To learn more about Vitaliy's investing firm, IMA, go to imausa.com. Stock investors, you have nothing to fear but fear itself. Originally published in Fortune magazine. The stock market is not your friend. You want to approach it the same way the American president should approach a one-on-one meeting with the Russian president. Be respectful, but cautious. He might smile at you and say all the right things, but despite the diplomatic niceties, your interests might not be aligned. The stock market awakens a dangerous emotion. Fear. It's sitting dormant in us all, awaiting an excuse to wake up. When stocks are going up, we may find ourselves engulfed in the fear of missing out, which is so predominant in our society that we even have an acronym for it. FOMO. When we are consumed by FOMO, our time horizon magically expands. We tell ourselves we are long-term investors, and our risk tolerance is infinite. Risk of decline? We puff out our chests and say, bring it on. And then when the market actually declines, a very different fear pays us a visit. The fear of loss. The invincible hero who conquered the FOMO moment shrivels to a husk of his former self when the fear of loss emerges. The chest collapses, and so does the time horizon, shrinking from years and years to months, days, or minutes. These two fears are not compatible with successful investing and have a zero-sum relationship with rational decisions. The more you are dominated by these fears, the less rational you are. Think of the total skill set of an investor as a multivariate equation in which all our skills are combined. The ability to value companies, to interpret financial statements, to understand and apply macro and microeconomics, to be an independent and creative thinker, etc. And then that grand sum must be multiplied by your ability to remain rational. Think of your ability to remain rational as a number between 0 and 1. If you are totally rational, you are a 1. But if you let the emotions generated by the last tick of the market seep into your investment process and dominate your buy and sell decisions, then it won't really matter what the sum of your other skills is. The sum will be multiplied by a big, fat 0. And thus, your total skill level as an investor will be exactly that. Yes, 0. You'll be doing what the average investor does, buying high and selling low. Thus, rationality is one of the most important qualities I'd be looking for in a money manager. Recent market volatility, a code word for when the market doesn't just go up, but also declines, makes the rationality discussion even more pertinent. Staying rational is a very proactive, not a reactive journey. Smart investors deliberately structure their lives and design our investment process to protect us from the toxicity of the market. The more you let the stock market into your life unguarded, the more room you create for fear, and the more your rationality slips from 1 towards 0. Investors are prone to two opposing but equally debilitating fears. The fear of missing out when times are good, and the fear of loss when markets are volatile. These two fears have a zero-sum relationship with rational decisions. The more you are dominated by these fears, the less rational you are. So what can we do as investors to move toward maximum rationality? Here's one piece of advice. Don't constantly watch your portfolio. Next time you notice the price of a stock you own moving up or down, think about the factors that may be influencing that move. Stocks are owned by people who have very different time horizons. You'll have mutual funds and hedge funds whose clients often have the patience of a 5-year-old. They are getting in and out of stocks based solely on what they expect them to do in the next month or 6 months, a rounding error of a time period in the life of a company that lasts decades. Some buyers and sellers are not even humans, but computer algorithms that are reacting to variables that have little or nothing to do with fundamentals of the company you're invested in. These players have a time horizon of milliseconds. You will also have folks who are buying and selling stock based on the pattern of its chart. Not that they don't know what the company does. They will tell you they don't care what it does. For them, it's just a chart with one squiggly line crossing another squiggly line. Then there are folks who spend more time researching the next movie they're going to see than the stock they're about to buy. Some of them buy a stock after reading a single article on the internet, while many others buy on the advice of their brilliant neighbor Joe, the orthodontist. Deciding not to constantly look at your portfolio is not necessarily the same thing as embracing the latest craze, passive investing. This one is a bit personal and requires a small detour. Interest rates are the foundation of the discount rate, also known as the required rate of return, that investors use to convert future cash flows into today's dollar. Think of the discount rate as being composed of 2 layers. The foundational layer, or the risk-free rate, that is the interest rate, let's say, on the 10-year treasury, and a risky layer that should compensate you for additional asset-specific risks. During the Great Recession, when central banks artificially changed the price of money by buying trillions in government and corporate bonds, that made the Soviet planned economy look like child's play. Instead of messing with kiddie stuff like setting prices on shoes or sugar, like the Soviet central planners did, a few dozen free market central bankers set the price of the single most important commodity, the risk-free rate, which is at the core of most economic decisions and the valuation of all assets. Valuation of companies whose earnings lie far, far in the future benefits dramatically from falling interest rates, while the valuation of companies whose earnings are not growing as much and are concentrated in the present and near future does not enjoy that benefit. A similar dynamic happens in the bond market. Bonds with short maturities, similar to value stocks, are impacted a lot less by declining interest rates than long-term bonds, similar to growth stocks. As the impact of suppressed interest rates rippled through the markets, active managers that had even a modicum of discipline in their stock selection found themselves trailing their benchmarks and even getting fired, while customer money flowed into index funds that indiscriminately buy what is in the index. So what is the index, you may ask? Most popular indices today are constructed based on companies' capitalization. Thus, companies that have done well lately, for example, the tech giant FANGs, that is Facebook, Apple, Netflix, and Alphabet's Google, get a much greater portion of new capital. In fact, the FANGs account for about 10% of the S&P 500 index. So high-duration companies are benefiting from both low interest rates and the dumbness of the indices. However, as investors who hold long-term bonds in 2018 are discovering, rising interest rates can hurt. We don't know what interest rates will do in the future, but today, the US government is running a $1 trillion budget deficit at a time when the economy is growing at a rate of almost 5%, before adjusting for inflation. What do you think the deficit is going to be when growth slows down or turns negative during a recession? And yes, those things do happen. To make things worse, these deficits add to the $21 trillion of US debt, which doubled over the last 10 years, while the government's interest payments didn't change, thanks to low interest rates. Higher, maybe even much higher, interest rates are not unlikely going forward. If you own the S&P 500 or long-term bonds, you implicitly think one of several things is true. Number one, interest rates have a 0 or insignificant probability of going up. Number two, I'll be able to get out in time. Or number three, I have a life-size statue of John Bogle in my living room, and I have a very, very, very long time horizon. Back to various actors who are responsible for daily ticks of your favorite stocks. If you are a fundamental investor, you are not just buying stocks, you are buying fractional ownership in businesses. You spend hundreds of hours on research. You read company financial reports. You talk to management, competitors, customers, suppliers. You build a financial model that looks years into the future to value a business, and also to predict what could kill it. If after you've done all that, you still find yourself glued to the computer screen, watching the price changes tick by tick, you are basically giving credence to the idea that what a company is worth should be decided by algorithmic funds. The guy who reads charts but cannot even spell the name of your company. Joe the neighbor. And an ETF with the IQ of a Halloween pumpkin. I don't want to insult everyday pumpkins here. In short, the less time you spend looking at your portfolio, the more rational you are going to be. So what can we do as investors to move towards maximum rationality? Here's one piece of advice. Turn off the TV. We rarely turn on business TV in our office. Stock market movements throughout the day are completely random. The same actors that are influencing the up and down ticks of individual stocks, actors whose goals and time horizon may have nothing in common with yours, are driving market movements. I feel for TV producers who must provide a continuous narrative to explain this randomness. Business TV presents additional dangers to your rationality. It reprograms you to think about the stock market as a game. In encouraging you to play that game, it puts you at risk of nullifying all the research you've done as you let your time horizon dwindle from years to minutes. It also threatens to strip you from the humility that is also needed in investing. Business TV guests who provide their opinions on stocks have to project an image of infallibility, the opposite of humility. Again, I sympathize with them. They are there to market themselves and their business, and thus they must project the image that they have an IQ of 200, holding forth on every possible topic. You are never going to hear from them the words that are the essence of investing. I don't know. Being unable to admit uncertainty is dangerous because it may cause you to stop thinking about investing in terms of probabilities. If you start thinking that the future only has one path, you may ignore other paths and thus other risks in your portfolio construction. If you tell yourself that you're an expert on every company, then your circle of competence has no boundaries, and your overconfidence may take you to places, and also investments, where you have no place being. Also, since I don't know is not part of their vocabulary, business TV guests will confidently answer questions that should never be asked, such as, what will the economy and stock market do next? If you have been investing long enough, it is hard not to develop opinions or hunches about what the stock market and economy will do next. However, good money managers work diligently to extinguish these hunches from their investment process, because those hunches lack repeatability. If you get the next leg of the stock market or economy right, that's just dumb luck. Nothing more and nothing less. Economic and stock market behavior, especially in the short term, are very random. God forbid your recent forecasting success goes to your head, because your ability to predict what will come next is not much different from your predicting the next card to be turned up in blackjack. My colleagues and I used to identify with our self-proclaimed I am a long-term investor brethren. However, over time this phrase has morphed to mean I am a buy and hold and never sell investor. Also, the term long-term investor, in our view, is a bit redundant, since there is no such thing as short-term investing in the stock market. If you are investing in stocks, then your time horizon should automatically be long term. Otherwise, you're just a trader deceiving yourself into thinking that you're an investor. However, investing is not just about the holding time horizon. The analytical time horizon is just as important. To us, being investors means having an attitude with which we look at stocks and process information. We buy businesses that happen to be listed on public exchanges, but our attitude toward them would not be much different if they were private. We view all news, be it quarterly guidance, whether it's great or disappointing, upgrades or downgrades by analysts, or any headline crossing our screens in the context of one question. How does this impact the value of the business? This perspective is liberating because you start to process the news flow very differently. You develop a resistance to the distractions of the everyday news dump. Quarterly earnings stop being about beating or missing guidance. Ultimately, this simple question, how does it impact the value of the business, filters out 90% of the noise and puts us on solid investment footing. Thank you for listening. This and other investment articles by Vitaliy are based on value investing principles that were first brought down from the mountain by Benjamin Graham and later were popularized by Warren Buffett. To learn more about these principles, visit investor.fm and listen to the first episode of this podcast, titled The 6 Commandments of Value Investing. To learn more about how Vitaliy's investment firm uses these principles to create low-risk, long-term oriented portfolios, visit imausa.com. Enjoy life and prosper.